Well, professional negligence occurs when a professional has not undertaken their work to the standard of a reasonably competent professional in that field. It's thought about as work undertaken which is not to an acceptable standard in that profession. Forensic accountants get involved in cases when lawyers begin to assess liability, and if there is a professional question to be asked around the competence and work done by an accountant, then forensic accountants will come into the case and typically be asked about the scope of work that was agreed, what that accountant who has allegedly been negligent, what he or she agreed to do, what he or she agreed not to do, or at least what was scoped out of their engagement. And often these people are codifying their engagement terms in engagement letters, so it's very clear what was agreed would be done and what would not be done. And that's usually the start point where the forensic accountant comes in and can help lawyers to interpret and understand what was intended to be done or indeed not be done under those engagement terms by the accountant concerned. In short, it comes down to what's on the files of the accountants. So in audit cases, there will be an audit file. Audit's highly regulated by reference to guidance in that field, international standards on auditing. So the file will need to comply with that, but it also needs to comply with experience and expertise of an auditor looking at the business in that particular field requiring an audit at that time. In tax, you'd expect lots of contemporaneous notes on file, advice notes, documentation, conversations with clients, meetings with clients, really to allow the tax advisor at the time to get to the nub of the question that client wants answered in tax. So really reviewing files, looking at the approach and thinking of the tax advisor at the time is key in these tax negligence cases. The principles are no different to any other case under English law. You're trying to put the client back into the position they would have been had they not suffered any wrong from the professional advice they were given. So at one end of the spectrum, it can be direct costs, the fees they've incurred, for example, which are easy to assess to a degree had they not taken on that advice. The more difficult thing at the other end of the spectrum is to assess indirect or consequential losses, such as the cost of taking on extra finance they wouldn't have taken on, perhaps the cost of lost from extra returns they would have got from investment opportunities they couldn't take, maybe loss of profits from contracts they couldn't take on. Ultimately, perhaps the entire demise of the business was caused by this professional advice, and you might be assessing the value of the entire company. So these are both the direct and indirect losses that accountants can end up assisting with in cases.